So conventional financing, I kind of alluded to this. So I'm not a conventional lender, I'm a private lender. A conventional lender is a bank who has the ability to use our money. We are depositors, we deposit in the bank, and the bank can use fractional reserve lending to lend out even more money, and so that's why the rates are cheap. Trust me, if you go anywhere else in the world, no one's getting 5% money. And I'll tell you why. There's some reasons why we have such cheap money, but we are unique here in the US. Our average interest rate over the last 100 years is 9.5%. That would be a normal, really healthy interest rate. It's good for borrowers because they can afford it, and it's good for lenders because they can make money when they lend it out. Problem is right now, if I can make 1% at the bank, I have a hard time retiring because I'm not getting a very good rate of return on my money. But because the Fed is willing to lend the money for free, or almost 25 basis points or 50 basis points, the banks can borrow from the Fed, and they don't have to pay us very much money. That's why the more secure assets are much lower value, because the Fed's willing to print the money, and they don't have to get it from us and pay us a better rate of return. Well, it's great for us as borrowers, but it's very bad for us if you're trying to retire, right? So what are you going to do with your savings? But at the end of the day, a conventional lender is going to take your money, multiply it, and then lend it out at the cheapest rate possible. And then most lenders will then sell that loan to Fannie Mae or Freddie Mac or whatever is called the secondary market, and someone else is going to buy it, and ultimately the Fed will end up buying it. So a conventional lender can print money basically for free, and then they'll sell that note to the Fed, who buys the notes, because the Fed bought Fannie Mae and Freddie Mac back in 2008. And so that's why our loans are so cheap. So if you can get a loan from a conventional bank as a borrower, you always should. I'm never going to compete with a conventional lender. I don't want to. We're in different spaces. Conventional lenders really want to lend on people's primary residences, and where most people buy houses, they're going to buy their one house that they live in. For the small sect of people who are saying, yes, I not only can own my own home, I want to buy investment properties, investment real estate, still, you should use a bank whenever you can because the money's cheap. But there's times what happens with the bank is that because the Fed is the one that's going to buy these notes at the end of it, they create this box. All these rules and regulations, 43% debt to income ratio and 2 years of employment, and your tax. You can't get a loan from a conventional bank if you haven't done your taxes. You know why? The Fed gets their money from taxes, so they're not going to give you a loan if you're not paying your taxes. That you're their income stream. So they can force everybody to be a part of the system that they ultimately do very well with. So people have another taxes or all this stuff. If you can't fit in the box, then you can't get a loan. If you can fit in the box, you always should, and then get a loan from the cheapest place. Hard money lenders, private lenders are like me or like Gary. We're lending our own money out. So I don't have to ask anybody. I have the money or I don't. And if you want to borrow it, I can say yes or I can say no. And the nice thing is that banks, they have to ask people. They have to fit you in a box. I get to define what my box is. And so the nice thing is I don't call my loans hard money loans. I call them make sense loans, because I do loans that make sense. You want to buy a house for $300 grand, you're going to put $100,000 down, you want to borrow can I borrow $200,000? Sure, that makes sense. Am I worried about you defaulting on that loan? No. If you want to buy a house for $300,000 and borrow $297,000, am I worried about you defaulting on that loan? Yeah, a little bit. I need to make sure that you have a really good job, making a really good income, that you are for sure going to be able to pay me back over time, because I'm really at risk here by making this loan. A private lender wants to make a loan that's not so risky up front. I'm going to lend you some, but we kind of do loans how banks used to do it. Back in the 50s, you couldn't go to the bank and say, hey, listen, can I get an 80% loan-to-value loan? They didn't make them. If you had half the price, if you had half the money, hey, will you loan me half to buy the house? They'd be, well, okay, maybe, right? It's only in this last 70 years where we've been able to print all this money, and money is basically free, that we can do these, really in some ways risky loans, and banks can do them. So a hard money lender or private money lender is lending on the hard asset. The hard money is I'm making an asset-based loan. Does the asset speak for itself? I don't even pull credit most of the time when I'm doing my loans. I'm just saying, if this didn't work out, let's talk amongst ourselves. Let's do this investment deal. If it doesn't work out, what are we going to do to pay back the loan? We'll sell the house. There's plenty of equity in the house to sell that I'm not worried about getting paid back. And so on deals like that, I can be very creative and I can be really fast. Because I'm lending my own money, I can lend it to you in a few days. I don't have TRID, I don't have any of the regulations that banks have. So literally, someone can come to me on Monday, bring me a deal that makes sense, and I can give them $400,000 or $500,000 on Friday to go do whatever they want to do with that property. Sometimes I'm refinancing someone's investment property. Sometimes they're acquiring an investment property. And the reason people would use my money over banks is because I can be so quick. So if you want to buy a house on foreclosure, or if you have a bank sale, or if you have a distressed seller, and your offer would be improved by the fact that you could close in 10 days, guaranteed cash 10 days or 5 days, if you can get that house for $20,000 or $30,000 less than you otherwise would have, is it bad for the borrower to pay 5 or 10 grand to me to borrow it? No, it makes sense. And you should only do a deal that makes sense. I don't want someone to pay more to me in interest than they would otherwise get in the reduction in the price of the house. So people come to us when people they're investors. They're buying houses that are not in good shape. It's a hoarder's house. It's a foreclosure. It's the roof leaks. There's no electrical panel. All these things that would make the house unconventionally lendable, perfect. I love those houses, right? Because a person can take some sweat equity, put in the electrical panel, fix up the house, and now the house goes from being worth $250, maybe it's worth $350 now by adding some sweat equity into it. That's how my people who borrow from me make money. So for the most part, I'd say 60% of the people who borrow money from me are buying and flipping houses. Other people who are just people who have their cash tied up in investment real estate and they need to make money for payroll, or they have a 1031 exchange, or they have some unique situation where they're not going to need the money for a long time, but I just needed to do this deal, I need the money for 3 or 4 months. Sure, I can do that. You can pay me back anytime. Maybe buy the house and you go get it. And once it's lendable, go get a conventional loan. People keep money with me for short periods of time. So we might charge 12% interest, but over 6 months, it's not that much. If you compare it over 30 years, it's crappy. But over 6 months, it's not such a big deal. And if you made money on the purchase, then it's a good deal. So that's what we do for a living. That's my only spiel on hard money lending, but in case you didn't know.